Record gold prices have led to long queues at bullion counters in many parts of the world. And viral footage like this shows how quickly interest has spread among younger buyers and retail investors. But what's really driving this rush? Market watchers say this rally is powered by two very different forces. One is long-term and structural and based on strong fundamentals. The other is short-term FOMO, fueled by social media. Both push prices higher, but in very different ways. One builds steadily over the years. The other creates volatility. Understanding how these forces interact is key to knowing what this rally means and how to deploy your cash. Gold's major bull cycles have historically lasted many years. The current uptrend began in 2018, and analysts say long-term drivers remain intact.
Bull markets never go up in a straight line. This gold rally that really started 7 years ago can have more legs if you look at what happened in the 1970s and in the early 2000s. The past rallies lasted between 10 and 11 years.
That long-term confidence has coincided with a surge in retail interest.
During the heat wave of the gold, there was a very long queue, and the queue number were actually given out early in the morning, and the waiting time is crazy, like 7 to 8 hours. 5 years ago, I was quite lucky that I managed to buy 100 grams from UOB. The price was actually $7,000. And then with a peak of 17,000 for 100 grams, I managed to sell just one piece. So it was quite amazing returns. So I hope to capture this wave again.
I'm from Batam, so I come here for a day. So usually when I'm in Singapore, I buy some gold. I try to do 3 times, 4 times a year. I want to have so many ounces a year, so I try to achieve that on a yearly basis. I keep the gold. I'm not selling it at the moment, so it's just for my pension for later and just for the safekeeping.
It was Diwali weekend and I saw queues of about 4 hours plus in Mustafa, and I was amazed that, oh my God, people are queuing up to get hand on physical gold at this skyrocketing prices.
But while retail enthusiasm has surged, market watchers say this is only the short-term story. The long-term force behind this rally is coming from deep structural demand that sits far beyond retail investors. Central banks now account for roughly 20% of total global gold demand, double their share before 2022.
For one thing, the US's role in the world is starting to evolve. Under the Trump administration, the role of the US dollar and the role of the US Treasury market as premier safe havens is starting to evolve as well. And many people then might turn to gold as the next best alternative as a safe haven to manage these ongoing risks.
Another key shift in this cycle, even with prices at record highs, many long-time holders are not selling.
So previously, usually at the highs, we expect clients, or rather, I would expect clients to be selling back. But at this moment, we don't see many of them. In fact, they're still holding on to their gold, which is something that is not usual.
And while prices have been boosted by social media trends, analysts warn this could also add volatility to the market.
A lot of demand in gold is driven by fear of missing out, and it's lacking the structural conviction.
With more retail participation, intraday movements have become sharper. Experts say that while gold remains a long-term safe haven, the current price environment is less stable for new entrants.
If you look at gold chart, right, intraday it has been moving like $100. I mean, have you seen days like that in history? No, right? There is no depth. So the structural buyers, right, are missing from those psychological levels of, say, 3,900 or round numbers of 4,000, right? So when you don't have the actual buyers, you just have people who are offloading or taking profit, right? the depth is missing. That's what causes a lot of volatility and erratic movements.
Another concern for market watchers? Gold climbed rapidly through key psychological levels such as 3,500 and 4,000 US dollars. They expect the market to slow and consolidate before any sustainable move higher.
I strongly feel that the pace was too fast and gold is missing consolidation between 3,500 to 4,000.
Gold has already corrected by around 300 to 400 US dollars from its peak this year. Analysts say such pullbacks are normal in fast-moving markets.
In the short term, you could see gold prices being very volatile, perhaps even pulling back. If it comes off further, it could actually be a buying opportunity.
For new investors drawn in by the recent surge, experts recommend a long-term approach. Keep gold to 5 to 10% of a diversified portfolio. Avoid large, one-time purchases during volatile times, and build positions gradually through dollar-cost averaging. Treat gold as a long-term stabilizer, not a short-term trade. So while gold's long-term fundamentals remain solid, the short-term picture is increasingly shaped by FOMO and fast intraday swings. For new buyers, the key is knowing which part of the cycle you're reacting to and staying disciplined for the long term.